So now we're going to cover, actually, Chapter 1. We are going to talk about Learning Objective 1-5. On the slide. So, understand the financial reporting consequences. A change for, number 1, a change in the equity method. Investee, other comprehensive income, investee losses, and the sale of an equity method investment. So, to report a change in the equity method, if an investment that was recorded at fair value reaches a point where significant influence is established, or all accounts are restated retroactively so the investor's financial statements appears as if the equity method has been applied since the date of acquisition. So sometimes you buy, let's say you own 10% of the stock and then you own 20% of the stock. Now that's changed. So you would retroactively make the financial statements appear as though the equity method had been applied the whole time. Reporting a change or retroactive adjustment. The company acquires 10% on January 1st, 2014. Giant company does not have the ability to exert significant influence over small. Giant properly records the investment using fair value method. In 2016, they purchased another 30% of Small's outstanding stock, thereby achieving significant influence. After changing to the equity method on January 1st, 2016, they must restate the prior years to present the investment as if the equity method had always been applied. The income restatement for these early years can be computed as follows. Equity investment. So although you only own 10%, you're just using the same equity method. So apply 10% of income and then 10% of dividends. So it's income minus dividends. So there should be a $5,000 adjustment for 2014, and then $11,000 minus 4, a $7,000. So a total adjustment to retained earnings in 2016 of $12,000. Giant's reported earnings for 2014 will increase by $5,000 and 15 by $7,000. To bring this retrospective adjustment to the equity method, Giant prepares the following journal entries. So they're going to increase the investment in Small, and they're going to increase retained earnings as a prior period adjustment. To adjust the 14 and 15 records so the investment account is accounted for using the equity method, they're going to have an unrealized holding gain in shareholders' equity and a fair value adjustment of $13,000. To remove the investor's percentage of increase in fair value, 10% of 130 from the stockholders' equity account. So that's what we're doing here. 10% of the stockholders' equity account. Other comprehensive income is defined as revenues, expenses, gains, and losses that under GAAP are included in comprehensive income but excluded from net income. Accumulated other comprehensive income, also known as AOCI, includes realized holding gains and losses on available for sale securities, foreign currency translation adjustments, and certain pension adjustments. OCI, or other comprehensive income, is accumulated and reported in stockholders' equity and represents a source of change in the investee's company's net assets that is recognized under the equity method. Other equity method recognition issues arise where irregular items traditionally include within net income. An investor must report its share of the following items reported: discontinued operations, extraordinary items, and other comprehensive income. So although we include net income, we also include these items, or our share of these items. We also talk about investee losses. A permanent decline in the investee's fair market value is recorded as an impairment loss, and the investment account is reduced to the fair value. When accumulated losses incurred and dividends paid by the investee reduce the investment account to zero, no further loss. So we can't take a loss, we can only write it down to zero. The investor discontinues using the equity method rather than a negative balance, and the balance remains at zero until subsequent profits eliminate all unrecognized losses. A temporary decline. So it has to be a permanent. Temporary is ignored. If part and investment is sold during the period, the equity method continues to be applied up to the date of the transaction. At the date of transaction, the investment account balance is reduced by the percentage of shares sold. If significant influence is lost, no retroactive adjustment is recorded. So you retroactively adjust if you gain significant influence, but you don't if you lose it. But the equity method is no longer applied going forward. We also want to cover Learning Objective 1-6, which is to describe the rationale and computations to defer unrealized gross profits on intra-entity inventory transfers until the goods are consumed or sold by outside parties. What we don't want to do is recognize gains or losses between selling ourselves into a company. So many equity acquisitions establish ties between companies to facilitate direct purchase and sale of inventory items. Such intra-entity transactions can occur either on a regular basis or only sporadically. If the investor sells to the investee, that is considered a downstream sale. If the investee sells to the investor, that's considered an upstream sale. The seller of the goods retains a partial stake in the inventory for as long as the buyer holds it. The earnings process is not considered complete at the time of the original sale. Reporting the profit is delayed until the inventory is consumed within operations or resold to an unrelated party. At the disposition of the inventory, the original sale is culminated and gross profit is recognized. So we don't report profit until we sell it to an outside party. Measurement of financial performance often affects the following: the firm's ability to raise capital, management compensation, and the ability to meet debt covenants and future interest rates and manager's reputation. One criticism of the equity method is that it overemphasizes on possession of 20 to 50% voting stock in deciding on significant influence versus control. It also allows off-balance sheet financing. So one of the companies can do the financing and the other company doesn't really recognize that. And there are potential manipulation of performance ratios. You can do things to one company or the other to make one or the other look better. Explain the rationale for reporting implications of the value accounting for investments otherwise accounted for by the equity method. Fair value reporting option. An entity may irrevocably elect fair value as the initial and subsequent measure for certain financial assets and liabilities, including investments accounted for under the equity method. Under this fair value option, changes in the fair value of the elected financial instruments are included in earnings. So this is an option. So now we're going to have another video reviewing how to do some problems in equity method.